Assalamualaikum warahmatullahi wabarakatuh. My name is Noni Srina Nabila binti Muhammad Azani and my metric number is 313900. Today, I will explain the distinction between bearer plants and biological assets in the context of a palm oil plantation, as well as the relevant MFRS standards and measurement basis. First, oil palm trees are classified as bearer plants under MFRS 116 property, plant and equipment. Bearer plants are living plants that are used in the production or supply of agricultural produce from more than one period. In this case, the oil palm trees are used to produce fresh fruit bunches or FFB over many years. Since their main purpose is to generate agricultural produce rather than to be harvested and sold themselves, they are treated similarly to machinery or equipment in a manufacturing company. Therefore, under MFRS 116, oil palm trees are measured at costless accumulated depreciation and any impairment loss. This accounting treatment reflects their role as long-term productive assets that provide economic benefit over their useful life. In contrast, the fresh fruit bunches or FFB growing on the trees are classified as biological assets under MFRS 141, agriculture. Unlike the trees, the FFB are intended to be harvested and sold. They also undergo biological transformation such as growth and maturation, which affect their value over time. As a result, MFRS 141 requires FFB to be measured at fair value less cost to sell at each reporting date. Any gain or loss arising from changes in fair value must be recognized immediately in profit or loss. This ensures that the financial statement reflects the current economic value of the agricultural produce. This distinction is important because it supports faithful representation in financial reporting. By applying the correct standards, the company can accurately report its asset and financial performance. It prevents the overstatement or understatement of asset and profit and provide reliable and relevant information for investors, creditors and other stakeholders to make informed decisions.
Hey everyone, my name is Muhammad Darwish Mikail bin Muhammad Lai. My number metric is 314044. I will now discuss whether the CFO's evaluation approach achieves faithful representation under the IAP conceptual framework. CFO's approach does not achieve faithful representation because it values immature price, food price or FFB at the same market price as harvested FFB. This approach lacks neutrality of industry biological risk by the disease and the uncertainty before the FFB nature. In addition, nature FFB are not the same as harvested FFB. They have not completed their biological transformation and cannot yet be harvested or sold, so they should not be reviewed equally. A more appropriate regulation will consider the remaining growth, expected loss, and risk before harvest, which provides for more realistic prevalence and better representation actual financial position.
Assalamualaikum warahmatullahi wabarakatuh, and my name is Iqbal Hakim Ibrahim with metric number 313802. So firstly, the ethical risk that I faced during this situation is I was instructed by my CFO to value the immature fresh fruit bunches using the full market price without considering the biological risk. This raises several ethical concerns. So firstly is my integrity and objectivity would be compromised because the valuations overstated the company's asset and profits. It also violates the professional competence and due care. As for MFRS 141 requires fair value to reflect the current conditions of immature FFB. Therefore, I should review the standard, gather evidence, discuss my concerns with the CFO, and escalate the issue if it's not resolved. So besides responding to the CFO instructions, I also have the professional responsibility to the external users of the financial statement, which is the investor, lenders, auditors, and also the regulators, to rely on an accurate financial information to make their decisions. Therefore, I must ensure that the financial statement comply with the MFRS 141, which is presenting a truthful information and protect the public interest. So in conclusions, I should not simply follow management instructions if they result in misleading financial reporting. Instead, I must ethically apply professional judgment and ensure that the financial statements faithfully representing the company's true financial positions.
Okay, good day everyone. So my name is Nur Fatima Azara binti Zairi, and today I will critically evaluate the correct accounting classification for prime development berhad. So there are three major property assets under MFRS. So for the property one, which is the corporate and retail tower, we actually need to split this one. So the 7 floors rented out to tenants go under MFRS 140, which is investment property. Because they are earning us a rental income, but the other 3 floors are used for our own corporate HQ, so that part falls under MFRS 116, which is PPE. So since this portion can be legally subdivided and sold separately, we have to account for them separately. Okay, so next is for the property 2, which is the horizontal land plot. So since the management is still undecided on what to do with the property 2, so now MFRS 140 is very clear about this, which is if the future use of the asset is still undetermined, so we all will automatically treat it as a capital appreciation. So this one safely goes under MFRS 140, which is investment property. Okay, so finally, let's look at property 3, which is the Zenith condominium. So even though it's still under construction, the clear business plan is to sell off their units to home buyers as soon as they finish. So it's held for a sale in the ordinary course of business. It will belongs under MFRS 102 inventory, which is plain and simple. That's all from me. Thank you. Next, I will explain the measurement basis for each property. Initially, all property are measured at cost. For property 1, the lease floor classified under MFRS 140 may subsequently use the fair value model, while the headquarter floor follow MFRS 116 and are measured using either the cost model or revaluation model. Property 2 is an investment property and may also be measured using fair value model after initial recognitions. For property 3, which is classified as inventory, it is measured at the lower of cost and net realizable value under MFRS 102. The CFO want all his property classified as investment property because rising property value would generate fair value gain and improve reported profit. However, this treatment is inappropriate. Property 1 contains an owner-occupied portions while Property 3 is being developed for sale. Therefore, they do not fully qualify as investment property under MFRS 140. By applying the fair value model to all assets, the company will overstate profit and asset, giving investors a misleading impression of the company financial positions. This violates the qualitative characteristic of faithful representation, which require financial information to be complete, neutral, and free from material error. In conclusion, each property must be measured according to its correct classifications. Therefore, the CFO blanket's proposal should be rejected because it does not faithfully represent the economic sustain of the properties.
So, good day everyone, and my name is Rina Natasha binti Syahrir and my matrix number is 312946. Today, I will be evaluate the product recall cost of fresh disc manufacturing Berhad. Under MFRF 137, we must recognize a provision of 1 million on the balance sheet because it meets all three criteria. First, present obligation. The public recall endorsement create a contractive obligation from the continuous juice distribution. 2. Probable outflow. There is a 70% estimate return rate clearing the more likely than not threshold. 3. Reliable estimate. The cost is reliable bounded, making 1 million the single most likely amount. Thank you. Next, for question A2, the consumer loss with this cannot recognize a provision here. Instead of MRF 137 require us to disclose it as a contingent liability in the note. This is because losing at the case is not probable. Legal counsels estimate only a 30% change of outflow, which fall well below the required 50% threshold for the solid liability. Thank you. Finally, for question B, MFRS 137 manage uncertainty through strict probable threshold to unhold the principle of prudence. With an outflow is probable over 50%, we record a provision like our recall. When it's merely possible under 50%, we only disclosure is like our large with this, ensure a faithful representation for investor. So that's conclusion my part. I will hand over the next presenter. Thank you.